Hi, everybody. I'm Scott Callon from Ichigo. Thank you so much for joining. This is, as is right in front of you, the FY24 Q1 corporate presentation. I am joined to my right by Dan Morisaku, who is a senior member of finance team and our head of global IR. Can we say hello?
Hi, everybody. Thank you very much for entering the call.
So starting with page 7, here's Q1 summary. Stock earnings are up 44% over last year. Our stock earnings to fixed expenses ratio is at 245. That's a good thing. So the higher that number, the better it is. As you know, we are structurally profitable. We designed that into the firm after the financial crisis. And so the growth of these stock earnings is really, really good. To be very clear, this is driven primarily by absolutely explosive growth in our hotel business. We took significant damage, certainly on a short-term earnings basis during COVID, where the hotel business went from being spectacularly profitable to spectacularly unprofitable. And now we're racing forward again towards spectacular profitability, which is really important and exciting. As you see on the page, we've got RevPAR already 28% versus pre-COVID. So the hotel business is doing the best it's ever done. We work very hard to keep our people. You should know there is an industry-wide labor shortage, and there's a labor shortage throughout Japan. It's particularly severe in the tourism sector. We protect our employment. It cost us money during COVID, but it's meant that we're able to capture the hotel demand that is emerging. That is, as I said, extremely strong. In the asset management business, we've got asset management fees that are linked to NOI. And we're seeing growth both in the office space and, as I said, the hotel spectacular growth in revenue, which is not only in the assets we own within this company, 2337, Ichigo Inc., but also within our hotel REITs. That is extremely contributory towards our earnings. The other thing that worth pointing out that we highlight is Ichigo Owners, which is our primarily super prime residential business with very high turnover. It has an average holding period of only about 7 months. It gives a very reduced low cost kind of provision to asset buyers, meaning we entered the business where other players were taking, we thought, too high margins. We get about a 10 to 15% gross margin in this business. Is growing very, very fast. We're expanding our sales channels. We launched our third co-ownership asset. I'll talk a little bit later. We will be launching, and actually I've already begun the sales activity around our second Ichigo Residence token. I'll talk about that later. And so there's a lot of things going on there too. Next page. You can see how things break out across the 3 main drivers of our business: sustainable real estate, which is of course overwhelmingly the biggest driver of our business, asset management, and clean energy. Clean energy is down a little bit because we've got maintenance activity with respect to our wind power plant, our major wind power plant. So that's as expected. Explosive growth in sustainable real estate. So stock earnings, that means contractual earnings. And so what I'm really talking about is rental income, and that's effectively almost entirely a rebound in hotel space. And asset management reflects both growth in Ichigo Office, both some increase in assets under management there, about 5%, but primarily substantial growth in NOI at Ichigo Office, plus spectacular growth in NOI at Ichigo Hotel. Because the office REIT is so much bigger than the hotel REIT, the office REIT is a bigger driver of asset management earnings. I'll jump to page 10. And look, we've actually got a ton of material. So I hope it's okay to go fast. And sorry for the technical failure, because the goal was to go fast rather than slow today. So I'm going to jump through pretty quickly. We tend to have robust Q&A. I hope we're going to have that again today. So please jump in if you think I've skipped anything or that's important. All in OP is pretty much flat. Cash EPS is up 23% year on year. As you know, we focus on cash, not accounting earnings. The flat OP reflects the fact that we had a very light quarter from a capital gains perspective, and we will not have a light year. So there's a bunch of stuff coming, Q2, Q3, Q4. Despite having hardly any capital gains during the quarter because of the spectacular growth in our stock earnings, primarily driven by the rebound in the hotel business, but across the board. I mean, Japan has reopened. things are really, really good. The forward outlook is as good as it's ever been. So we end up being flat on an all-in OP basis, and cash EPS has actually gone up fairly substantially. Next page. This is how things break out. Asset management, all-in operating profit plus 20%. Sustainable real estate is effectively flat. That's because, as I said earlier, huge growth in stock earnings being offset by a decrease in flow earnings. That is not representative of what will happen during the full year, but that's what the first quarter looks like. And clean energy down year on year on primarily, as I say, maintenance expenses that are one-off. Next page, we're actually jumping to page 13. Look, this is a material that we provide on an ongoing basis. It speaks to kind of structural elements of the business model. I will go quickly through this and maybe even just skip some pages. You should see on this page that we have an increase in our fixed expenses from about 8 billion a year to 9 billion a year for the full year forecast. Over half of that is people costs. I mean, we've increased salaries as we should, and there's been some inflation in Japan. So this is reflecting kind of a little bit of inflation environment, but primarily us choosing to pay our people more. Page 14. What's worth pointing out here is our all-time record high for stock earnings, was basically right around the number on FY22, so fiscal year 20, February 20, a little bit higher than that in the fiscal year 2019, that one in February 2019. Our forecast for this year is is about 17 billion yen. It is quite possible. Not only do we beat this year's forecast, but we set a record for Ichigo as a firm in terms of our stock earnings. If we were able to declare today that is done, we would be telling you that today we would be raising our forecast. There is, of course, a significant link. We've got 22% of our assets in hotels. They are a very, very profitable asset class. So we're probably generating at this point about a third of our stock earnings within the sustainable real estate business out of hotels. So what happens with the hotels over the next year is going to be important. But if things go as they're going right now, it is quite possible we could have record earnings. So let's see what we can do it for all of you. I'll skip through the next couple pages. 16. The only thing worth pointing out is that it's a small number relative to what we normally do. So this shows, we have all these embedded profits in the firm, unrealized gains, and what's the multiple against those gains that we actually get when we realize. Meaning, we have third-party appraisers who tell us what are embedded kind of forward earnings look like based on unrealized gains. We always beat that. We got like a really small number for the first quarter. We don't think that is representative for the full year. It's basically not statistically significant. We think we end up the year at something that looks like between 1.5 and 2x. And then 17, very quickly, our economic operating cash flow exceeds net income. We are all about generating the maximum amount of cash for our shareholders over the long term. And we use that cash, as well as we can for you, right? We invest for growth. That can mean investing in the business. It can also mean buying back our stock. We didn't make a stock buyback announcement today. You should fully expect us to be active in the stock as appropriate. And so there's no signal from not having an announcement today. Turning to page 18, we continue to finance really well. Rates have gone up in Japan. They haven't gone up for us. And yeah, it's still a remarkable time to borrow money and invest on behalf of all of you. I mean, one of the huge advantages of Japan is you can borrow, if you're creditworthy like Ichigo is, extraordinary amounts of money, fixed, covenant-less, covenant-light for a long term, and we continue to do so. And we think that's important to do that in order to decrease our cost of capital and deliver more value for you as shareholders. Page 19, again, this is kind of update information. We are very active as a firm. We have a significant clean energy business. We are recognized broadly within Japan as being a company that cares and implements in a global best practice way on ESG. And so we are increasingly able to borrow within ESG frameworks. And these are great. I mean, this is very, very, wonderful terms and conditions. They are We don't pay more for ESG borrowing, we pay less, and the terms and conditions tend to be better. So the fact that about a third of our ESG loan, our loans are ESG right now, is good, and we expect to grow that over time. Next page shows that we are climate positive. We substantially, we have, the blue shows how much CO2 generation we do. We have been pushing that very, very substantial over time. As you can see, the green is our actual production of either via solar or wind power plants, how much we contribute to CO2 reduction. And you can see that the green bar is much, much higher than the blue bar. Next page shows what we're doing in terms of our own, and this is really about the blue bar on the previous page, converting over to renewable energy. We're currently at 71% across the firm. We expect to get to 85% this year and by 100 by 2025. And again, separate from this, we have all this massive power production. I'll move to page 23. Selective acquisitions and sales. I think we've used this title for like the last 10 years. Because we are selective at acquisitions and sales. We are very careful about where we deploy your capital, and conservative about it. I mean, there's always a margin of safety on acquisitions, and attached to a very clear-headed view as to how we're going to add value to an asset when we buy it. And on the sales side, we just, you can count on us to run a very, very robust sales process when we sell anything. And get the maximum price for genuine value creation that we have done. We were net acquirers, as you can see on the page, of about 14 billion yen. That is almost entirely Ichigo owners. That business again is kind of prime, super prime, residential, brand new, delivered by us to investors, running from individuals to big global institutions who want access to highly secure returns in Japanese real estate. As you know, residential is a very robust and steady and stable asset class in terms of NOI. People pay the rent, they particularly pay the rent in Japan. And so this has been a very strong substitute for it creates yield for our country where there really is no yield. So instead of owning Japanese bonds and cash that offer you effectively nothing, you own resi and real estate that offers you, substantially more than that. And these days, it looks like something like 3 to 4% return. Next page touches a little bit on what's happening with hotels. And as you can see, RevPAR is up. I mean, this launch. So RevPAR is revenue per available room. Plunged during COVID, and now it's rebounded and is 30% above pre-COVID, and that's just despite inbound tourism still only recovered to 70% to pre-COVID levels. So what we're suggesting is, at some point, Japan is just really, really attractive for tourists. You should all come. I mean, it's spectacularly delicious and friendly and clean and safe. And with no social conflict, and cheap where the yen is, and so I think it's pretty straightforward to underwrite to continuing growth in Japanese inbound tourism. Part of that's also linked to the fact that tourism globally kind of grows faster than GDP. It particularly is, and that's particularly the case with economies that are moving up in terms of income levels, which describe the broad amount of Asia. So Japan is close to Asia. It's a great place to come, and it's an affordable place to come. So there's a lot of growth here. Next page shows what we're doing in terms of capturing that hotel demand. 3 areas that we actually expanded during COVID to position long-term growth. One is we have a hotel operator called 105 Hotels. We have maintained 90% occupancy previous and through COVID. That involved pushing down RevPAR hard. But we kept the hotels up and running. We kept the employment, and we kept ourselves ready for a rebound at some point, and that rebound has occurred. Prepare, as you know, is our AI-based hotel revenue management system. Now, we use that internally, and we use it really effectively. What we haven't delivered upon for you yet, and we've got a bunch of work going on there, is more substantial external sales of this. because it's a very powerful revenue management system. And I'll touch a little bit on the next page, and that's back to be there that hopefully we will provide for all of you that will make you happy. We have two Ichigo hotel brands, the Knot, which is kind of a higher level of boutique hotel brand, and 1.5, which is more kind of what's the right way describe it? It's probably budget. I mean, I hate to use the word budget because the soft service and hospitality is really, really good, and that's part of the reason why it's succeeded very well. But both brands are proving to be very effective and powerful drawers of tourists, both inbound and domestic. Page 26. I think the really only thing here to point to is we are broadening, diversifying hotel earnings. We're moving beyond earnings that are driven by asset ownership, meaning kind of operating income and gains of sales. The hotel operator will turn robustly positive. 1.5 will turn robustly positive this year. We expect to see expanded activity with Prepare and asset management. There's more to be done there, and we will be generating stock earnings these businesses in a non-asset way. Next page just kind of points to this is what we do as a bread and butter and sustainable real estate. Some examples of the activity that we have had in the retail space. I don't know how many of you know Akihabara, which is the main hub in central Tokyo. Both of these assets are right smack in front of the station. Like you walk out of the station and boom, right in front of you are these two buildings owned by us, like literally feet away. And this is what we do. They're older assets, 40 years plus in both cases. We have spec'd them up to make that sure they are totally earthquakes safe, and the structural engineering is right for them to run for hundreds of years. And during the COVID period, I think in one of them, let's see, either SoftMap or Mbande Namco, we did two summers ago, and the other one we did last year, but massive increase in rents based on kind of the quality that we have provided and the suburban location. So what we do, you will see more examples of this. Very, very powerful in terms of, look, at the end of the day, these assets have value because of the NOI that they generate. We are intensely focused on driving up higher NOI in order to create more value for our shareholders or buyers, because that's what we do. We create value, we make them more valuable, and then we sell them on recycled capital for you. Page 28 shows what's going on. It's somewhat busy. We want to show you the timeline over time. Ichigo owners, where demand is very, very robust. You can see that we've used more conservative assumptions. For this year, we expect to sell about 50 billion yen last year and generate 4.2 billion yen of operating profit. That has got a lower gross margin assumption relative to last year, where we did 20 billion yen and generate 3.5 billion of operating profit. We've done so well over the years. We just feel like it's probably smarter to underwrite to lower gross margins, so we'll see what happens. But at any rate, there will be ongoing growth in this business, and we're generating that. We're doing the acquisitions you can see on the bottom in order to fund this growth. Next page shows some of the new initiatives. Both are focused on kind of bringing new owners into real estate. The one on the left is a co-ownership business. Really, they kind of it's a limited partnership, probably the best way of describing it relative to on the right. I mean, on the left, it does give you actual real estate ownership, and so you can get kind of depreciation allowances, and so it's like physical ownership of an asset, and we offer diversified small scale investments for larger individuals and kind of high net worth and cash rich companies to own diversified portfolio. On the right side, I've talked about this before, we are actually doing tokens on the blockchain. And this is not, and I've said this before, this is asset backed. So it's real. You don't have to kind of believe in the future of Bitcoin. It is kind of really like a REIT, but it's taking the shape of a token. And it's an interesting question as to why people want to buy this versus buy a REIT on the Tokyo Stock Exchange. And the answer is, they can make whatever choice they want. It turns out that the buyers of these tokens skew younger, they skew more male, and they skew a lot younger. than our REIT shareholders, but it is effectively kind of the same product. You want to buy it via token, you want to, and you know, you just boom, boom, just buy it via token. But it gives you this ongoing secure return, just like we offer our investors via our REIT, our REITs. I'll turn to the REITs now. You know, it's our job to support these REITs and grow value for all the REIT shareholders. We believe in asset management and believe asset management is fundamentally about serving the shareholders of those that you have kind of a covenant with. So it's a way of saying anything that we do in the REIT space needs to fit the needs of the REIT shareholders. We will never kind of violate that covenant. It has meant that, you know, for example, over the years, we have not done public offerings nearly as often as many of our REIT sponsor peers, because we've taken a very skeptical view on whether or not those POs, public offerings, really make sense for the shareholders of the REITs themselves. And we do not use REITs as like exit vehicles for things that we wouldn't want to own ourselves. So anyway, we've done a bunch on the REITs. This is a long presentation. I'll run forward, but those are our values, and you can continue to count on us to intensively serve the REIT shareholders. And you know, at the end of the day, the goal is to be recognized and rewarded for that. I'll talk a little bit about our returns on Ichigo Office REIT that kind of support the market understanding, you know, what we do in the space and why we're good at. Next page shows some of the activity. You know, one of the things we do want to do is we want to increase alignment between us. So Ichigo Inc. 237 is the asset manager of these REITs. And so doing everything you can to align yourself as a sponsor with the REIT shareholders, we think is very important. And one of the ways we have done that is we've actually bought the REITs ourselves. And so we are co-owners of the REITs, and it's underscoring our commitment to drive shareholder value for the REIT shareholders. We're just like you. If we don't succeed, it damages us. And it's, you know, at the end of the day, we're going to do our best for REITs also. We want to show the alignment in a physical way through ownership. Talk is cheap. So that's what we're doing. Page 32 addresses recently there was a shareholder, Ichigo Office REIT. They called a shareholder meeting to make a large number of proposals. And at the end of the day, the Ichigo Office shareholders overwhelmingly voted for Ichigo. And that was a positive outcome. It was an opportunity for us to re-engage with our shareholders at Ichigo Office REIT, and that's what happened. You know, and our hypothesis of why that happened is really kind of based on what we've done for the shareholders over the years. So the next page shows the outperformance of Ichigo Office REIT, and we have just absolutely crushed the market. So this is our job. This is why investors trust their life savings or their institutional savings to Ichigo, because we work really, really hard to deliver outstanding performance, and we have definitely done that with Ichigo Office, and the Ichigo Office shareholders recognize that. Next page shows what's happened with dividend growth, which has also been very, very, very high. For a long period of time, we were the single highest performing REIT in Japan of all the REITs in terms of consecutive years of dividend growth. Unfortunately, that disappeared in 2019. You can run for it. It's pretty hard where there is some underlying volatility in NOI for you to, and this is a distribution vehicle for you to like always grow earnings forever. But anyway, we've done very, very well, and we will continue to do well for our shareholders. And next page shows NAV growth, which is similar. You know, it doesn't move quite as spectacularly as we've been. There's been a lot of growth there. Turning quickly to the clean energy business, there will be more growth there. We have a little bit of a push down this year on one-off maintenance costs, as I pointed out earlier, particularly with respect to the wind power plant. And we've got a pipeline of green biomass and non-FIT solar that's coming that we think will be very additive, not just to our earnings, but to the world. This is about, you know, we are all experiencing today, Tokyo has been blazingly hot as it has been in the last couple of days, but we're all experiencing globally, you know, enormous kind of weather turbulence and kind of trying to get ourselves off fossil fuels in order to address that issue is critically important to the planet. And we're deeply involved and are going to be even more involved. Final page of the presentation before the appendix. We continue to have our daily shareholder program, which is is extraordinarily innovative. We offer it to all shareholders, not just for the owners of this company, but to all the shareholders of our REITs. And the J League is back and roaring and opening, and that's a much better place to be than a very difficult COVID period. So we're giving out all these free tickets to all our shareholders, and it's a happy time. That's what I got. Thank you so much for your patient listening. Apologies for the technical difficulties at the very beginning. I'm happy to take any questions or comments. And again, thank you so much. So if anybody wants to either raise their hand or wait a minute, somebody already has, and I think it's Greg. Greg, thank you. Are you there?
Hi, Scott. Can you hear me?
Yep. Thank you so much.
Yeah, thank you for your time. I have a couple of questions.
Yes, sir.
First, on the Ichigo owners, remember you started the year with your guidance. I think you highlighted indeed probably lower gross profit margins.
Yeah.
How is that kind of trending versus your initial expectations? Would be my first question.
Yeah. So don't have a lot of data for you on that, meaning we haven't done anything really of interest. And we're working on some big transactions. But I think we're gonna hit these numbers. Does that answer your question? So you're asking for some input on how are things tracking, and I don't have an answer for you.
Okay.
Probably talk next quarter or the quarter after that.
Understood. And my second question was, you touched upon salary increase for the staff and the hotels.
Yeah.
Can you maybe just expand a little bit on that? And what was the range, kind of broadly speaking, of what you did on kind of base, and are you also kind of helping out with kind of summer variable bonuses, or maybe if you had color, that would be great.
It was overwhelmingly focused on the base, but as you know, we have a system like most Japanese companies where you get a base and then you have a bonus, which is some multiple of your base. And so by raising everyone's bases, and we literally raised the bases of everybody, on average about 5%, but extraordinarily skewed towards younger staff and lower salaries. And the thinking about this was, look, Japan is experiencing inflation in a way that hasn't experienced literally in decades, and we need to take care of our people. And Greg, to be clear, it was not a decision based on kind of what's happening in the market and where are salaries and we need to do this. It was just it was exactly that. When we got together as a management team, it's like, wow, some of our younger folks who have less experience and lower salaries are really experiencing an inflation hit, and we should fix this, and we should fix it for everybody. So on average, 5%, but there were people that are much higher than that, and the guys who are paid more were much lower than that. And we just explained, this is what we're doing.
That's great, thank you. And the third question is on the Propera, software revenues.
Yeah.
Have you been able to kind of develop that post-COVID? Are you able to get more kind of third-party accounts?
Yeah. And the answer at this point is no. So that's a KPI that we've missed, and we've got. I'm sucking in. I've been in Japan for most of my life. You can tell from my accent, and Greg knows this. I'm from California, but I've spent most of my life in Japan. So when you hesitate on something, you're sucking air. And sucking air element is, what should I say on this topic? I mean, we're working on some large transactions, and I don't know if they come through and how soon they come through. But this has been an interesting experience of spectacularly, and maybe Anna, should we show this, one of the pages that shows kind of this very quickly, the page 26. It says 10 to 40% earnings increase PA. I mean, that's the right range. Normally looks like more like 20 to 30% plus for the hotels that have introduced this system. And so those numbers are so big and so powerful. You would expect us to be selling this system like hotcakes. And it's been really fascinating to see how difficult the sales process has been with hotel operators. It's like, don't you want this? It's like free money. And like, no, we're fine with our current system. It's like, oh, okay. So we've done a bunch of work on how we work on the sales process, and we implement it for free and all that sort of thing. And so we'll see if we get some breakthroughs sometime soon, but we haven't done nearly as much in this space in terms of the external selling activity. It clearly is a very powerful tool for us to deliver not only higher NOI from our own hotels, but give us a competitive advantage because we do, when we introduce it, we systematically get higher returns. So anyway, we'll see. Sometime hoping the next year we'll have an announcement where we've done something really, really big externally, but at the moment we haven't delivered on it. And to give you some sense of that, growth from last year has been about 20% in terms of external customers for it. But that's a low base, so it's not as if it's not growing at all, but it's not growing nearly enough to satisfy us, or I think satisfy you.
Understood, thank you. And then one last question, any update regarding Tradepia, the vacancy rate, please?
Tradepia?
Yeah.
Tradepia is currently at 58% occupancy. It is contracted to be, it'll be 64 soon. The target for this year is to be 70. I think we hit that. But it is the kind of the one. As you know, we own one big office. It is that one. It has had a completely different experience from our small and mid-sized offices that are running at occupancy nearly 100%. So that is an asset we've had to work quite a bit on. And that's where it went down to 58. Actually went down below 50. It's now 58. It's contracted to go to 64. We think we get above 70 this year.
Okay, great. Thanks very much, Scott.
Yeah. The only good news on Tradepia is that finally it looks like we're turning the corner. Boy, has that been hard. And a reminder that we overwhelmingly prefer the small and mid-size. There's a long story around this, and we actually made the money on the asset, and but it is proved to be far more work and than we had expected when we first bought it because of the COVID experience. Things happen.
Okay, thanks very much.
Thank you very much. We have a question that's come in by via chat. From Michael, and I'll just read it out loud. Remote working is a new normal in Europe and the US with only 60-80% presence on premise. What is the trend in Japan? How's it impacting Ichigo offices, assets and strategy? So Michael, I mean, the Tradepia competition is a worthy one. So again, that's the only large office building we own, which is and large office buildings are generally occupied by larger companies, which is, and speaking from our data set, so it's been that the large companies are slightly more remote. It's not as the SMEs that occupy our buildings are less remote. But the key difference is the large companies are more remote, and they've been therefore pushing back space. And we've effectively gotten no space pushback. And what's the decisions that are being made by our tenants are. And I've talked about this before, so forgive me for reiterating. So there's a war for talent in Japan. There's a labor shortage, and particularly the smaller companies who can have possibly less brand. They're actually trying to use office space as a way to attract talent. And we have really good offices, really well located. And so to be in the Ichigo office means it's going to be a nice space. And so what we're hearing from our tenants is, pre-COVID we were 100%. In the office, now we're only 70%, and we're going to keep our space. In other words, you give effectively 50% more space per worker, and that's nice. We'll be able to put in a lounge. We want to give more space per individual. As you know, office space per individual per worker in Japan is small anyway. So increasing this to more like global standards or European standards is something that our tenants have chosen to do. So the short answer to your question is. Going remote has not impacted demand in any way, in any material way, in the small and mid-sized offices, which are bread and butter. And in fact, it appears to be a demand driver, because one of the things that's happening is the big guys are pushing space back and they want smaller offices, so they're coming to us. And the other reason why you would push a space back is because it's more expensive. And so to be clear, a larger office building in Tokyo, by the way, it's much more expensive to build larger office buildings. You have to gather all the land. You generally have to pay premiums to some of the owners to get some of the land. It's much more expensive to do the structural engineering to make a building earthquake safe. And so it's just far more value for the money to do a small and mid-sized office. But anyway, you would normally be paying, and this is the Japanese size, 3.3 meters squared, but it's called a tsubo. You would pay kind of like 30,000 yen for tsubo for reasonable office space in Tokyo. That's larger. And in our case, it generally is something like 16,000, 18,000. In other words, we're like 40 to 50% cheaper. And so what's happening with the remote work is that people are migrating to our size and our cost point. So we actually think Office is really interesting because there's still kind of a bunch of people out there going, well, we don't know about Office and how's it going to turn out. We have been doing a small amount of acquisition offices. Small amount meaning kind of we also, as I said before, we're selective on acquisitions and sales, but we think it's an interesting place. And you should expect us to continue to be active there. Happy to take Will. We're going to demute you. Are you there?
Yeah, hi, can you hear me?
Yes. Thank you for joining.
Thank you for hosting this. Two questions. The first is on the RevPAR increase, 28% over pre-COVID. So can you explain what were the drivers of that? Was this rebranding, CapEx investment, different, just operational efforts to raise pricing? Just kind of get into what drove this. And then of your existing, I guess you said 24% of your current assets are hotel.
Yeah.
Is there room for further expansion as these sort of efforts are ongoing into the next year or two? You just give some color there.
Absolutely. And forgive me, I'm going to give you a qualitative response because we did a number of things simultaneously, and it's small data rather than big data, so it's hard to tease the two out. But I think the two drivers, the biggest driver is Prepara. We implemented Prepara. It really, really works. And the second one is branding. We have rolled out the Knot and the 1-5 brands. They've been very, very successful. And when I say the branding, it's about and forgive me. Let me walk a bit back. I mean, it's a service provision that is valuable and wanted by travelers that we have branded the Knot and the 1-5, meaning, the classic Japanese hotel, and I've said this before, so please forgive me, it's like, it's a box, it's really cheap, or alternatively, you can pay tons of money for the Four Seasons, and there's really been nothing in the middle. And so trying to find something that's more in the middle, where it's not just a box and you actually get some soft service and you get kind of people caring about you, and both the Knot and the 1-5 brands have really, really good food. I mean, and this is a country that cares about food, and people come here care about food. So there's some elements about making it a much higher quality experience at still a spectacular great price. I mean, 1,000 to 11,000 yen is less than $100 a night. I mean, this is still really, really good value. So I would say it's those two. It's Prepara, and it's also our service offer that has driven this increase. And yes, there's upside. There's no question there's upside.
Great, thanks, Sue. Thanks very much. The second question is on what can we expect in terms of AUM growth rates, either in sort of maybe average value per year, this year, next year, 2 years, and office and hotel. Obviously, the hotel had some trouble in the most recent PO, so it might be a while before we see one there. But can you give us some maybe color on when that might next be, et cetera? Just on AUM growth generally.
Yeah. So look, the honest answer is that's hard to say, because at the end of the day, I'll give you the thinking, and then maybe we can come up with something that makes sense. We exist to serve the REIT shareholders, and I think unfortunately, it's not necessarily the case. You can say that about all J-REIT sponsors. So we need to be able to grow, and because these are distribution vehicles, in order to grow, you need to do public offerings. So we think it's really, really important to make sure the public offerings grow value for the REIT shareholders. We're highly confident we can do that with the hotel REIT today. We are actually confident that we can do that with the office REIT also. I mean, the whole hotel REIT's just easier. I mean, we've got an edge that's very powerful linked to Prepara, and kind of our ability, and hotel business in general, it has poor execution in Japan. So, despite Japan in the hospitality area having the best restaurants on the planet, it doesn't have the best hotels. So there's more to be done there. So look, and so we have ambitions to grow, and we think we can grow. Yeah, I mean, can you underwrite the hotel REIT to double-digit AUM growth on a CAGR? I think so. Yeah, I mean, because the opportunity is available and it's relatively small. And I would be minimum. The office REIT is harder to think. But I think it will grow. I mean, we've been growing it primarily through growing value and selling assets and making money and reinvesting those assets and making more money, and so it has been driven by primarily organic growth, and that's fine. And the returns for shareholders, as I pointed out earlier, whatever page it was, have been great. Page 33. And yet, you know, we do have investors who say, we want you to be bigger. We want more liquidity. We like what you do. Could you please get bigger so we can participate more? So we'll see where we can take that. But I think the most definitive version I can give you is that we haven't grown either of these vehicles very much for years, and they will start to grow. And that will be a change. And it's also a firm priority to grow them. We believe in the asset management business. We believe in serving the world. And by the way, when there wasn't inflation in Japan, you had money in the bank. It wasn't a problem in terms of loss of kind of destruction of value, economic value for a saver. Now that we have inflation in Japan, it is a real problem. And so for us to deliver what we can in terms of robust returns for Japan savers through our REITs is something that I think has significant social importance, and so we want to grow it. So yes, I think you can underwrite hotel REIT to double-digit growth per annum. It's harder for me to say what the office will look like, but we'll get some growth there too. Is that sufficiently?
That's good.
Is that okay?
That's very good. That's a
I
good.
did my best, Will.
No, that's good. Thank you. I said two, but if you don't, can do one more. On the renewables, I think it was last quarter you mentioned that you might pursue a strategy of accepting outside capital and then developing the asset on behalf of the investor rather than owning the assets yourselves. So this was a bit of a hybrid asset light model. Can you maybe update us on where that's going and what we might see going forward in that business model?
Yeah, we're really interested in that. And I don't know if people noticed, but we made a very senior hire recently. Akira Yamanouchi, who ran Daiwa's asset management business and ran the sustainable asset businesses. And he has very significant, and he joined us as vice chairman, actually in the last few months. And he has very, very significant experience both on the asset management side and the clean energy side. So if you're trying to get some sense of priorities inductively from what the hiring that we're doing at a very, very senior level, that would give you. But I think we're being responsive both on your asset management question on this one. So we'll see where we can go. But yeah, there is a wall of demand for clean energy. And we are a strong provider in this. This is a business we want to grow more. And I mean, the growth has been okay, but I try to be pretty transparent. I wish we had done more, and we still want to do more. And we clearly have an opportunity to do more. So you will see accelerated growth in this area. I feel pretty comfortable in stating that as the forward direction for the firm.
Thanks, Scott.
Okay.
That's good. That's good for me.
Thanks. All right, we're going to call it a day. Thank you, everybody, so much. It's an honor and a privilege to work for all of you.